In 2026, inflation is no longer the loud emergency it once was. It's not dominating every news headline, and it's not creating daily panic on Wall Street. But that doesn't mean it's gone. In fact, inflation is doing something far more powerful right now. It's quietly reshaping the winners and losers of the US stock market. And the shift is subtle enough that many investors don't even realize it's happening. A few years ago, when inflation first surged, markets reacted aggressively.
Growth stocks crashed. Tech valuations collapsed. The Federal Reserve raised interest rates at the fastest pace in decades. Investors suddenly had to reprice everything, from future earnings to corporate debt. It was dramatic, emotional, and volatile. But fast forward to 2026, and the market has adjusted. Inflation is no longer shocking. It's embedded into expectations.
And that adjustment has changed which companies are thriving. Today's inflation environment is different from what we saw at its peak. It's more persistent in certain sectors, especially services, housing, and healthcare. Wages have structurally moved higher, and labor remains tight in many industries. Energy prices continue to fluctuate due to global supply dynamics and geopolitical uncertainty. Supply chains are shorter and more regional than they were before.
All of this creates a new economic reality, one that rewards certain business models while quietly pressuring others. One of the biggest winners in this environment is companies with strong pricing power. These are businesses that can raise prices without losing customers. When costs rise, they simply pass those costs along. Consumers may not like paying more, but they continue buying because they trust the brand or depend on the product. In 2026, investors are rewarding reliability over hype. Companies that protect their margins during inflation are seeing stronger stock performance than companies chasing aggressive expansion. Another major shift is the return of profitability as the main priority. During the era of near-zero interest rates, investors were willing to pay high premiums for future growth. Companies didn't need strong earnings today. They just needed a compelling story about tomorrow. But inflation changed that mindset.
Higher interest rates mean future earnings are worth less in today's dollars. So now, real cash flow matters more than projections. Companies generating consistent free cash flow, maintaining balance sheets, and controlling expenses are attracting long-term capital. Dividend-paying stocks are also experiencing a quiet comeback. For years, dividends were seen as boring or slow. But in an inflationary environment, reliable income becomes extremely valuable. Investors are increasingly drawn to companies that not only pay dividends, but grow them consistently. Dividend growth protects purchasing power over time. As inflation chips away at cash savings, these steady income streams provide a sense of financial stability that speculative stocks simply cannot match. Certain sectors have emerged as structural beneficiaries of this new inflation era. Energy companies, for example, have regained attention. When inflation is partly driven by commodity prices, energy producers often benefit directly. Limited supply growth combined with global demand volatility has strengthened margins for disciplined producers. Industrial companies tied to infrastructure spending and domestic manufacturing are also seeing long-term support. As the U.S. continues reshoring supply chains and investing in domestic production, capital flows into these sectors remain strong.
Financial stocks are another interesting case in 2026. Higher interest rates, sustained by persistent inflation, allow banks to earn stronger lending margins. However, the difference between strong and weak institutions has become clearer. Investors are no longer buying the entire banking sector blindly. They are focusing on well-capitalized banks with conservative risk management. Selectivity has replaced broad optimism. At the same time, some former market favorites are struggling to adapt.
Highly leveraged companies face higher borrowing costs that directly reduce profits. Businesses dependent on heavy consumer spending are feeling pressure as households prioritize essential goods and services. Inflation has changed spending behavior. Consumers are more price-conscious and deliberate. They compare options, switch brands, and delay non-essential purchases. Companies that fail to adjust pricing strategies or cost structures are seeing slower growth. Technology remains important, but the type of technology leading the market has evolved. In 2026, profitable tech companies focused on efficiency, automation, and artificial intelligence integration are outperforming. Businesses that help other companies reduce costs or improve productivity are thriving. Inflation increases the demand for operational efficiency. Investors are favoring practical innovation that delivers measurable savings rather than distant, unproven concepts. Real estate is also experiencing a divide.
Some property sectors are benefiting from inflation-linked rent increases and strong demand, particularly industrial spaces and data infrastructure facilities. However, other areas, especially traditional office spaces, continue to face structural challenges. Inflation impacts financing costs, tenant demand, and property valuations differently across real estate categories. Once again, careful selection matters more than broad exposure. Perhaps the most significant impact of inflation in 2026 is psychological. Investors no longer assume inflation will always remain low. That assumption shaped markets for over a decade. Now, risk premiums are higher, valuations are more disciplined. Companies must prove their durability. The market has become less forgiving of weak fundamentals and overly optimistic projections. In many ways, inflation has forced a return to classic investing principles: strong earnings, manageable debt, pricing power, and consistent cash flow. For individual investors, this shift offers both challenges and opportunities. The easy money era rewarded risk-taking. The inflation-adjusted era rewards discipline. Focusing on companies with resilient business models, strong competitive advantages, and financial strength is more important than chasing short-term momentum. Portfolio diversification across sectors that can withstand inflation pressures adds another layer of stability. May not feel dramatic anymore. It may not dominate daily conversations. But beneath the surface, it continues shaping capital flows, corporate strategies, and investor behavior. The biggest stock market winners of 2026 are not necessarily the most exciting companies. They are the most adaptable.
They are businesses built to operate successfully, even when costs rise and economic conditions shift. Understanding this quiet transformation is what separates reactive investors from strategic ones. Inflation hasn't disappeared. It has matured, and the investors who recognize how it is influencing sector performance, valuation discipline, and corporate profitability are positioning themselves ahead of the curve. Because in 2026, the real stock market advantage doesn't belong to Image Prompt 1.